Well, the problem with the passive ETFs, Brian, is the fact that they cannot really structurally beat the mortgage-backed securities index. Based on trading fees and fees to their investors, they structurally tend to underperform the mortgage-backed securities index, somewhere between 50 and 20 basis points per year. Unlike a stock index, the fixed income indices are really impossible to replicate completely. With stocks, you can go out and buy the stocks, every stock in the index and the weightings that are in the index. For fixed income indices, there are thousands of different securities. So they have to go out and do a matrix type investing where they're buying not only the valuable mortgage-backed securities, but also the ones that aren't so valuable.
Okay, so the viewers out there, if they're interested, what exactly are you buying? A lot of ETFs in general, not just in the debt markets, but everywhere, are kind of confusing. I mean, the names are confusing. They have cute tickers. When you buy the JMBS, what are you buying?
Yeah, and we want to be very clear about this with our investors. Mortgage-backed securities have gotten kind of a bad name since the global financial crisis. What we're buying is actually agency mortgage-backed securities, the one that are issued by the government enterprises. They have the same credit risk as the U.S. Treasury. So there is virtually no credit risk in these securities. So there's a very big difference between agency mortgage-backed securities, which we're buying, and non-agency mortgage-backed securities, which help bring about the global financial crisis.
Okay, for the uninitiated, to your point, though, John, who do remember the financial crisis, Lehman Brothers failed this week 10 years ago because of a lot of junk debt and subprime loans that should have never been made and then rolled in. What is an agency mortgage-backed security? What does that mean?
Yeah, so we have three government enterprises, Fannie Mae, Freddie Mac, Ginnie Mae. And basically, they operate somewhat differently, but what the investor needs to know, when they take out a mortgage, their mortgage, if it qualifies, high credit quality, a certain loan size, it'll go to one of those government agencies who will guarantee the principal and interest coming from that mortgage to the end investor, which would be investors like JanusHenderson.
So you're buying safe mortgages, not subprime stuff that got everybody in trouble a decade ago.
Exactly. There's no subprime in this type of ETF. And in fact, when we go around and talk to our investors, what they're most concerned about right now is interest rate risk and credit risk. And this ETF is perfect for those investors that want less interest rate risk and virtually no credit risk.